See, there's nothing more sad than somebody sitting and actually predicting that there's a top in the market and actually knowing that this guy is short or actually is out of the market, has been standing on the sidelines. That's not what I am. I've been extremely bullish and I've done well since 2022 because I went into the market there and I stayed with the market. And every dip we had, also in 22, every dip we have had, I've been buying more. I've been buying every month into the market, various assets. And I'm in the most risk-prone assets right now, you can say.
The government shutdown remains in effect, gold is pumping like a meme stock in heat, and asset markets keep pushing higher, all while everyone keeps wondering when the bubble is going to burst. Hello and welcome to Milk Road Macro, the podcast that knows that what goes up must go up, and up, and up, and up. I'm your host, John Gillen. Today is Wednesday, October 8th, and we are joined by Henrik Zeberg. Henrik is a macroeconomist renowned for his expertise on business cycles. He currently serves as head macroeconomist at Swissblock, and he recently published a book called The Monetary House of Cards, The Bust of the Everything Bubble Caused by Central Bank Hubris. So as you can imagine, I am very excited to talk to Henrik. I hope you are too. And if that sounds good to you, make sure you like and subscribe. Share this episode with someone who is going to enjoy it. And as a reminder, our Milk Road Macro research team lives and breathes this stuff. Every month we drop a sharp report that breaks down everything that's going on in macro, so it's easy to understand. This latest report we just wrote dropped this weekend. It's packed with charts. I think we've got like 50 charts in this thing, just explaining what running it hot means and what you need to know about that. So if you want to get in on the alpha there, join our pro community today. Link is below in the show notes. And without further ado, welcome to Milk Road Macro, Henrik Zeberg. How are you, sir?
Thank you very much for having me on today. I'm great.
I'm really happy to have you. I think I have a lot of questions I want to ask you, but I want to just start with the big picture. If you would please walk us through your macro framework. How are you thinking about the economy and the market right now?
Well, I'm thinking about right now. I'm thinking about it in a cyclical terms because I think people have a tendency to think that that the economy can just go in one direction the one day and then the next another direction the other day. That's not how a almost 9 billion people economy works. It's simply too simplistic. It may be what we think the media can come out and tell us, but the reality is that the economy is a super tanker, and the super tanker will turn, but it will turn very slowly. But when it starts to turn, then there is a lot of momentum in that, and that's how I think of the business cycle as well. And when you look at the economy, then there are things that tells us that things are getting bad. These are what are in the leading indicators. The leading indicators are something also that the conference board are following. I just have a little other take on it than they have because they kind of also jump into the wagon of saying, oh, now it shows this and now it shows that. That's not really how it works. So what I think you're seeing right now is a slowdown that has been going on at least since, let's say, 24, Q3, Q4, 24, and very significantly in my model, you have a crossover in the leading indicators in late 24. Similarly, we had a crossover in the leading indicators back in 2006 in November as well, and that led to a recession in 2007 in December. So when the leading indicators is rolling over, that's not the moment when you call and say, oh, now things are bad, which is actually what the conference board is doing. What you need to wait for is for the real economy, which is not the real economy being the employment and GDP numbers and so on, starting to make notice of this, and in PMI numbers and the likes, and that happens a little later. So in the real economy, you will then see the coincident indicators, as I call them. In 2007, you had the crossover there in November of 2007, and now we haven't seen that yet. We are also only here in October now. But we're seeing that they are getting down very close to having that same crossover, which, by the way, has not happened in 22 when everybody was calling for a recession, which did not happen when we had in this year, also in Q1 when everybody was freaking out about a recession there, or it did actually happen into COVID. So in 2019, it actually showed the same, and so on and so forth. For 70 years back, when we have had the real call on a quarterly level, it has always made a right call. There's never been a recession that has not occurred. And we have that leading indicator crossover now. So it's only about observing the coincident indicators, the real economy, which Fed 6-9 months ago thought we had a great economy. You may remember that, him coming out and saying, oh, we have the strong economy, and my colleagues from the other central banks are like, saying, how can you do so well? And then it turns out, oh boy, we don't have that strong economy in the US. We actually have a labor market that is weakening, and is weakening fast. And And that kind of comes as a surprise, where it actually shows in the leading indicators, just in 2024 in November, that we are now seeing a cooling of it, and it now shows more and more in the labor market. And you have seen that the non-farm payrolls have been revised a lot here in August, and we can see that the quality of job is falling. We can see that the long-term duration unemployment is also rising, which you only see into a recession, and so on and so forth. Which means that the real economy, which is not what the financial world is looking at, really, and that's apparently, but that's the big, I really don't understand how this can be. But you don't see that they actually look to this. They kind of say, oh, but the liquidity coming in, and hence you're going to see the world is fantastic down the road because the markets are going up. Again and again, we have seen that. We have seen liquidity coming in into the end cycle. The Fed starts to cut, and they are too late. I think we see the exact same setup this time, only this time we are now coming to the end of the monetary experiment that they kicked off in 2008, where they have been just putting money or sending money into the system every time we have seen any kind of slowdown or anything like that. For a long time, it has been working. It's worked because you can see that the inflation has been pushing down. We have had globalized system, supply chain in the world. Now we're starting to see some, disruption in that, and we see other things as well. And we have seen inflation coming back into the minds of people, and that is what is causing the significant change here. So is the Fed? They're now standing again here, a situation where they think they have a problem with inflation, which is so ridiculous. I can't even point it out. In 2008, inflation was at 5.5%, and they were. It was not. We don't recall 2008 as an inflationary problem at that point. We thought of it as a deflationary problem. At this point, we're 2.7, 2.9%, and we're seeing the coincident indicators are rolling over. They are horribly late, and they need to come in. Starting to pump money in at some point. So we're right here waiting for that big moment where things is going to fall to develop in that manner. At least I am. But meanwhile, I also know that things are not just because there is a hole in there's a damage to the hull or to the Titanic that is going to sink immediately, and that's why I'm still very, very bullish the market at this point. I think you can see markets really accelerating to the upside, and only to do that into an Eiffel Tower kind of top. We're not there yet, and Bitcoin is not there yet. Crypto is not there yet. We're going to have a fantastic alt season, but that is not the same as things are great. That is actually a sign that things are not great.
So there's a lot in that. I want to kind of break that down over the course of the episode, but I think to still kind of build out some of the macro scaffolding here, you have popularized this idea of the Zeberg business cycle model. And I think this really closely parallels some work we've done at Milk Road Macro on, we call it spring, summer, winter, fall. There are 4 phases of this cycle. Just tell our audience, what is the Zeberg business cycle model? What are those 4 stages? And where in that cycle model are we right now?
So when people are talking about business cycles, they always say, where are we in the business cycle? Where are we in the economy? But actually, the economy is not just one thing. Again, it's a simplistic kind of view. You can say that you can look at employment and then say that is a view on the economy. What I'm saying is that you have different components to the economy that comes in at different phases. And you have the leading indicators, which is the one part of it. And then you have the coincident, which is the employment and the GDP and so on. And then you have lagging indicators, which is inflation, it yields, and so on and so forth, which is actually declining after you see the rollover of the economy, and also rising afterwards. And that's why, for instance, when you saw the whole COVID situation and we saw the stimulus coming out, when did we see inflation? It came in much, much later. It came in 22 because it's actually lagging, because you have the supply chains and so on and so forth. So there are these 3 levels here. You have the leading, coincident, and lagging indicators. And if you ask to then the 4 phases of that, which is actually also, as I see it, then each of these indicators can be described by a long-term trend. And the long-term trend is often given by the long-term growth rate in the economy. So the economy grows by 2.9% real-term growth over a very long time frame. But sometimes the economy accelerates above that trend line. So we kind of have a trend line going up like that. They'll see the economy grows above it, and then it comes to a cyclical top, and then it starts to decline. These are actually the two first phases that you have. The phase 1, which is above above long-term growth and rising, and then you'll have above and declining, and then you'll have below long-term growth, and declining, and below and rising. These are the four phases simply. So it's simply a sinus curve that goes like that and crossing the long-term average GDP on a long time frame. And you cannot avoid that. There will always be ups and downs. They cannot be avoided, even though the Fed seems to think that they can, avoid or simply just eradicate the whole everything that's called a recession or a slowdown. So that's how the model works, and there are different indicators to that. It's not just based on one. I see a lot of business cycle people saying, "Oh, we use the PMI." But guess what? PMI are surveys. So you go ask people, how do you think things are going to happen tomorrow? The best thing they can say is what happened yesterday. And the problem is they don't see the turns. So they will always be late there at best, coincident or maybe even late to that. So you don't see the turn there. Where you can see it is where you start to look at the housing market. You can look to yields and the likes, yield spreads, and then start to see if things are happening there. That's because there's something going on, and that moves much faster than whatever any kind of survey will do. So you need to look to those kind of things. And as I said, the leading indicators have been in my business model have been telling us that something bad is coming down the road. It's done that I don't know how many times over the last 70 years. Never been wrong on a quarterly basis, and they crossed that in November last year. And that's why I'm saying there's going to be a slowdown, and we see that slowdown now. So that is the Zeberg business cycle model. On top of that, we then need to understand that that's not the same as investing into the market, because even though you have a slowdown in the economy in phase 2 there, you can still see that the economy can grow and can support, especially when the central banks are coming in with liquidity. And then you see the stock market actually going into the most parabolic phase, into the final end of it, which is the phase we're in right now, where the business cycle is rolling over. We start to see liquidity coming in, central banks around the world. Forget about the Fed, that's just one of them around the world. But if you look to the rest of the world, there are 170 some cuts already around the world, which is challenging the level we saw into COVID. And we are getting up closer to what we saw into the financial crisis. So the situation is not as great as everybody thinks. And if you look to the financial world, you're looking into a lagging mirror of where the real economy is going.
So again, tons of great alpha and insight in there. I want to keep breaking this down piece by piece. You've said, and you mentioned this again in this interview, but I saw you say in a recent interview that the metaphor you used was that the economy has already hit the iceberg, but the ship has not yet started to sink. I want to take those in little pieces there, but the first thing of hitting the iceberg, what does that mean when the economy has hit the iceberg? Tell us a little bit about what that means and what you're seeing that backs up that thesis.
It's really, again, because people need to understand that when things are happening in the economy, then you offset kind of a psychological process in things, and people will start to think, oh, okay, I can't afford this any longer. I can't. I will have to postpone that kind of refurbishment or whatever it is, or the building a new whatever it can be in your garden or something that will cost some kind of money or investment. And when you start to see some of these things, and especially if you see them on a more aggregate level, that is the moment where things become bad enough for other things to start to unfold. And that is the domino effect of things. So it's really just, one domino that starts to fall. And when you cross a certain threshold on that, you can say, okay, now we have seen enough for things actually to start to fall. It doesn't mean it will happen immediately, but that is the ship hitting the iceberg. It's again, the metaphor is that the Titanic sailing, and everything is great, and we're going full speed because we want to get to New York in record time. And then there is an iceberg. You hit it. And everybody's saying, "Oh, that was not good," but hey, it seems like everything is fine. Somebody goes out and still can get a drink at the bar, and you can still do a dance, and the music is playing. So what is wrong? I mean, why should it be so bad? And it takes an hour, 2 hours, and then all of a sudden you start to get wet feet. And the trouble is that it's the people on the third class that start to get their feet wet first. So if you ask the population in the U.S. and you ask the lowest income tier, you'll see that they are not well, and they're not well off. And its consumption is 70% of the U.S. GDP, like it is in many countries. So that you have now 15.6% in the new survey saying that U.S. population or citizens are saying it's difficult to put food on the table. It's actually, very hard to get enough food. 15.6%, that's a lot. That's a large ratio of the population having problems with that. If that's the situation, how likely are they to go buy a new car or buy anything else if they just struggle to get food on the table? So I think this is where the financial world is just completely missing out, and seeing those numbers. And again, there's a famous quote in The Big Short where he says nobody looks, and it's really down to that. It's down to look at the consumer. And there was a journalist on the FOMC not so long, 6 months ago, asking Powell, what is it that the consumer doesn't get? Because they are kind of depressed if you look to the consumer confidence levels. And Powell kind of brushed it off and said, yeah, it's because something with tariffs and so on and so forth. Guess what? The consumers have been depressed for quite some time, and they are actually even more depressed right now. So this is where I think that the Fed, I don't know what they're looking at, but I think they are detached to the reality of the world, which has nothing to do with liquidity coming in unless the consumer can support it. And right now you see a deterioration amongst the consumer that will come out, and it starts in the lower levels, and then it'll move up. And just like with the water in the Titanic, third class, second class, first class. But yeah, hey, first class can party on for a little while, and I think it'll be a great party. And I'm part of that. At least I don't know if I'm part of the first class, but I'm part of the party. At least I'm trying to be, and have another drink before we're getting in the water.
Yeah, well, I guess liquidity isn't fun when your feet are getting wet. So I want to talk about this a little bit more. So you've talked about how the music plays on, the party keeps going, even though we've hit the iceberg. Assets are pushing higher. Gold made 4,000. Bitcoin made a new all-time high. The S&P 500 is closing in on 7,000. How high does this go? How much room to run does this bull run have before, like you said, the water starts to rise and the Titanic starts to sink?
Well, it all depends on one very big factor, as according to my model, and that is down to the dollar. And all of these things can have a great day for as long as we see that the dollar is declining and is not rising fast. And now we start to hear people saying, oh, but the dollar is also, I don't know, dying, but at least, declining, and everybody's, don't want to be part of the dollar and all that. And I think that is actually showing the kind of sentiment that we have, which is completely wrong. The dollar is the cleanest shirt that we have out there amongst a lot of not so clean shirts. And it's actually the cleanest. And the dollar is only correcting right now, which is what people need to understand. And the problem, when the dollar starts to rise and it finds a bottom here in October, November, that's the moment when things are starting to actually also unfold. Because we can look at all these fantastic things and say, oh, but we can accept a market capitalization to 220 some right now at this point, which, by the way, was at 107% back in 2007 and 130% in the largest bubble we have ever seen in 2000. Now we are 230% or something. And if we add on the crypto market, well, then we are 235 or something like that. We're crazy numbers at this point. How long can that go on? Until the reckoning day, which is when the dollar starts to rise. And that day is not so far away. And when you look at the technical structures, you start to see the strengthening of the dollar in terms of the technical bottoming process it's in. And when that starts to rise, then it's over. That's game over. And that's why I'm looking to that one. So we can have another, I'm saying 7,500, 7,800 on the S&P, maybe 8,000, and I'm still very long, a lot of risk asset at this point, because you can see when we have these blow off tops as it is now. And I see that Paul Tudor Jones is joining me on that and calling that. It was obvious since 22, but hey, he's welcome. But we're moving into that kind of blow off top, and you can just look at how well things worked out after NASDAQ top like that in 2000, and you saw also in 1989 when we saw the Nikkei topping out like that. How great were things back then? Not so great. So we are getting into a fantastic opportunity if you're long things right now, and you'll think this goes on forever, because nobody likes the bearer of bad news. I'm just a boomer, and I'm just a perma bear. I heard on the Swedish TV I was on the other day from somebody commenting on it. And actually, I'm the most bullish since 2022, but I'm just saying it's coming to an end now. And that's the not there yet, but we're getting closer to it.
I think that's a really helpful framing for the audience. I want to talk about some of these leading indicators or indicators that you're paying attention to say, hey, this run might come to the end. I hear what you're saying about, there being a lot of room to run to the upside on the S&P, on gold, on crypto, Bitcoin. One thing I heard you say in an interview that I hadn't heard anybody mention before was you were watching Singapore as a leading indicator for a market top. I'd love to hear your rationale on that. But then also, you mentioned the dollar, the DXY bottoming out as a sign that the run is over. And if the dollar shoots up in value, all these other assets will come down. Do you have a target for the DXY in terms of a bottom? Do you think it'll get to 90? Or are you just watching for when it does bottom and turns around, and that's the signal you're looking for? Just walk us through some of these leading indicators that you're using here.
So the dollar is telling us, first of all, you would not have had this kind of move if the dollar was above 100 or something like that. So you probably see that the dollar now will continue a little lower here. And I start at 90, not seeing that at all. I see around actually 95 to 96 is probably not as low as 95. So we're actually just in the final phase of this. This can be a more drawn out kind of process as I see it technically. So you'll probably see that it goes on for another month or a month and a half even, but and it will be a downward trend, but it'll be more muted. What you will see is that the euphoria or the negativity on the dollar is going to rise, and you're going to see sentiment saying, "Oh, the dollar is just shit and will be thrown out or whatever." And that's why Bitcoin will reign and all these things. This is what we need to see, because otherwise we'll not get a big bottom in the dollar. So I'm waiting for that kind of the psychology of things is actually a great indicator by itself. But there are some levels also on the dollar, especially the euro dollar, where it's around 120. When we get there, I think it's closing in on the top, and we have to remember that the decline we have seen is actually a decline, a correction ever since the very big top we had in 22. I think it was September 22, and that people really understand the consequences of. So the Dixie, as I see it, can run to 117 to 220. On the next bull run, and that will crush all the risk assets. So they need to be careful. Leading indicators, yeah, of course, Hong Kong also, but also I come from a small economy, and we know that if Big Brother down south, Germany gets a cold, we will get something much worse. We will get pneumonia here, and the same goes for the U.S. obviously for the rest of the world. So if the U.S. starts to see, so that's why it's good to look to small economies, because if they start to wobble and you start to see problems there, you'll see that that's actually a good sign, a good indicator. And when people were so bearish in March and April of this year, in March especially, you could just look to the Singapore index and say it's actually been outperforming NASDAQ. People were calling for a top in the NASDAQ in December. Remember that? And I was saying there was no way. First of all, you don't have a recession according to the business cycle. Secondly, how could you see that the Singapore index, which is a highly trade-dependent economy, actually outperforming the NASDAQ 3-4 months after the NASDAQ should have made a top? And this was into a trade tariff war kind of thing. It just didn't make sense at all. And hence, here we are. And I said we were going to see a V-shaped recovery, which is what we're seeing. And now people are starting to say, oh, now there's nothing stops this train. I can promise you there's a lot of things that can stop this train. So we're looking at these things, and then you can look to yield spreads. You can look to credit spreads. Then one of the things that I'm saying why I'm also still bullish is because the yield spreads, the credit spreads are not spiking to the degree I want to see. Because we need to see the short-term yield starting to drop quite fast. We don't see that at this point, and for as long as it doesn't, well, then we could easily see this go on for, I don't know, a month, 2 months, and that's why I will not call the when. I will call it the where when we get there. And I can say we can look at a few things and say, okay, now we have a certain indicator starting to flash. So people saying, oh, but you said then that no, I'm saying the levels that we need to get to. And for as long as I'm long my portfolio, I'm not calling any top, I can promise you, because then I would be persistent otherwise. So we are heading higher here, and it's just about how crazy this becomes before we see a top. And the only thing people need to understand that this time is not different. This time is absolutely, it's different in that we have the largest bubble ever, and when it crashes, it's going to be really bad.
Okay, so there's a lot in there. You mentioned your portfolio. I want to ask some questions about that because I think a lot of people would be very interested. But I want to kind of come to this idea of, the largest bubble ever. This has been going on for a long time, and you mentioned that, and a lot of macro analysts have been pointing to this too, that the Federal Reserve and central banks in general are trying to step in with a lot of liquidity to sort of like keep this bull run going, to paper over a lot of these problems. Central banks have been kicking this fiscal can down the road for decades, much farther and longer than I think most macroeconomists thought that they ever could. Why do you think that they're not going to be able to just continue to do that? Like, what is going to be the thing that blocks them from being able to just, add more liquidity and keep the Titanic afloat for a little bit longer?
First of all, there's not been a situation where they needed to taper it over since COVID. And before that, you did not have a situation since actually 2008 and said the recession in the financial crisis. What you have seen is that the central banks are trying to sprinkle liquidity on every small problem that we have seen coming up. And what they have created is a monster in the financial market, really a monster where valuation levels are completely off the chart in terms of what would be considered normal. You have a whole crypto market that's just looking into saying, oh, we don't care about what it creates of yields, and I'll still be speculating about this particular meme coin, and it's going to go to the moon, which it probably is, because of somebody else just coming to buy it. I mean, just the very talk of this and how it's actually being set up is the very definition of this bubble. So now you say, what is different? Why can't they just keep doing that? First of all, because now for this time around, we see, like in 2019 into the COVID situation, and in 2007, we see that the business cycle is rolling over. It hasn't done that ever since then, because they have been able to keep it going, as you said, with stimulus. This time, you're actually seeing that the consumer is now getting hit by the one thing that kills all cycles, which is inflation. So when inflation comes in, the Fed has to step in, because people then, otherwise we can see inflation keeps going up, and they do. Now that gives a double whammy to the consumer, because first of all, you saw the inflation level, not the flood of it coming in, because that's going down, but the level has risen by 20% or something since 2020. So all consumers around the world, they just faced another 20% on the cost of living. Then we also gave them a stimulus check, so they've been able to actually keep it going for some time, which is why it's taking a little longer. But inflation has been killing them. What is happening meanwhile is that the yields have been moving up. So we saw yields moving up quite a lot, which means that nobody can afford to buy a home these days. So if you look at the home sales, the existing home sales in the US, it's actually in the gutter, even though unemployment rates are really low at this point compared to other times when we were at similar levels. So everybody's sitting there with a job. They can't really sell their home and they feel the squeeze of that, which is why there's so many people in the US that can't, put food on the table, find it difficult to do that. So the situation is that this is hurting the real economy. And this is what people tend to not understand. When is the real economy hit? That's when you see these rollover of these leading indicators. You saw that in 19, where it predicted also a recession, my model. It showed that in 2007, where it predicted a recession, it came, and so on. And now you see it again. You didn't see it in 22, when everybody was calling for a recession in 22. I did not. You had the leading indicators were up in the sky, and the same with the coincidence. There was no way you're going to see a recession there. Could you see a very hard pullback? Yeah, but it was not a recession. No, by any means, at all. So people are not observing the right things. People are really not looking, and that's the problem. Look to the consumers. Look at how they are struggling just to make ends meet, and then understand that by the end of the day, there's nothing else driving the economy than the consumer. You can try to drive valuation up to certain levels, and then you think you can actually get the trickle-down effect. Remember, even liquidity is meant to affect the consumer. But if the consumer doesn't buy into that, then there's nothing to do with it. Then the liquidity doesn't help. It only spirals the financial world into craziness, which is what we see right now. So we are in a situation where the crazy world, the financial world, thinks, oh, this is just going to the moon, and keeps going because the Fed is coming in. Guess what? Every time the Fed comes in, they don't do it because things are great. They come in because things are bad. And just mention one time where we have seen a rollover the business cycle where the Fed actually saved the day. They never did. They never did. So the Fed is horribly late because they look out the rear window when they're driving, and that's what they do again. They focus on inflation at this point where we have inflation at 2.7, 2.9, which is nothing, while we see the non-farm payrolls are just really bad, and you see the quality of job also deteriorating, and long-term unemployment is moving up actually to higher levels that we haven't seen any time since the 1950s into 2009. It's actually rather remarkable that we have a U.S. market that looks like that, a U.S. labor market. So I don't know where they get it from, but I know that a lot of people that I talk to, they seem to point to the financial market. And I just say, okay, if you look at the financial market for direction, then you probably miss the top in the Nikkei 1999. You probably miss the Nasdaq, and every time this spikes up in a vertical manner, which it is doing right now. So there's a top coming, and it's going to be bad.
So I really appreciate the perspective on that. I think something that stands out to me, well, a few things. Number one, you said that the Federal Reserve central banks are reactive, not proactive. That's very true. In history, like they come into, sort of rescue the bodies after the crash has happened, but they're not usually effective at preventing all crashes that come into the market and the economy. Another thing I think I'm taking away that I'm hearing you're saying is that you have to look at the consumer, and instead of a lot of modern monetary theorists will look at the top level, or like you said, like the biggest economy like America, but really it's smaller economies and smaller participants in the market that are the ones who feel these impacts the most severely and first, and that should be your leading indicator. Really helpful perspective shift. I want to ask a question about artificial intelligence. I've heard a lot of analysts, macro analysts, and just market participants in general talking about the huge productivity gains that are coming from AI and how that's rapidly changing the economy. I think the Trump administration has taken this perspective of trying to run the economy hot, grow our way out of these problems, and try to use artificial intelligence to do that. Do you think that there is any validity to that? Can that sort of extend how long the music plays on, or what's the flaw in that thinking or that approach to this?
I mean, I don't even understand it, honestly. I mean, just think about the logic to it. Okay, so what we're going to do is that we're going to take, let me just follow the first part of it. There are so many things, it's wrong to so many levels. So let's start out with one of them. Okay, we take artificial intelligence and put it into a business, and it increases productivity 50 times, or 50%, let's just say 50% or 100% or something like that. What are you going to do as a business then? Are you going to hire more people? No, you're probably going to lay off people, because why would you need extra capacity if there's no buying? So great that you can increase your capacity, but that means that your colleague to the right is not needed any longer. How can that increase that we're going to have a better economy? Of course it will, but down the road. But I'm talking about right here and right now. That's not going to help. That's actually going to shed people, push people out if that's going to do anything. Okay, now it sounds like I'm against AI and I think it's a bad thing. It's actually not. It's fantastic. AI is going to change the world. It's going to lift the productivity levels of the world, and it's going to create, wonders that we can only dream of today. But now let's go back in time and look at 1920, and then look into mid-1920. What did we see there? We saw the emergence of new technologies like the radio, and we saw the emergence of the car, and of electricity. Sorry, that's a difficult word to say. Electrification also. Now, just think about the productivity gains that came out of that in the 1920s. Did that prevent a blow-off top and a very large crash in the market? The answer is it did not. Now go back to 1840s, and you had the railway mania, where you also had a technology which would change the world completely. The steam engine came out. All of a sudden you could travel, from east to west in the UK. It was back then, mostly, and also in the US, obviously. But did that prevent actually to evolve into a crisis? No, it did not, because people were front running this, and it actually created a spike in the stock market. And you saw everybody thinking, you got to get a guarantee for your money here, because we have a new technology. It's coming out. It's going to be fantastic. 1840s, 1920s, and then we go to 2000, the year 2000. We saw the internet coming out. Did it change the world? 100% it did. 100%. We wouldn't be talking here, you and I, if it wasn't for that technology shift. it completely changed my world for what I would have done in my future, in my life, with the internet coming out, sitting here talking to you and others. But did it prevent that we had a bubble there? No, it did not. So the problem is people are front running these things and thinking that it will be fantastic with this new technology and it's going to save the GDP growth and so on. The problem is, yes, it's going to change the world 100%, but it's not going to save us from the other thing, because the speculation that comes in and always follows, is going to put us into a bubble. And when you can look at the bubble, you can look at the ratios and say, this is a bubble by any means. And people are saying to me, Henrik, it's because you don't understand AI, or it's because you don't understand blockchain. I do. I actually do, but I do not do not say that it's going to prevent everything, because the problem is we are already front running this. You're already front running it. So you cannot just keep this alive. That's the problem. And again, I want to also say, first thing that's happened is that actually Mrs. Johnson there is going to lose her job because he's not as effective as the AI is. Is that a good thing for the economy over the next 3 to 6 months? It's not. It's a bad thing. You actually would like to keep her on the payroll for some time because it will take a time. And if she's above 50, now I'm 50, you'll actually see that is probably one of the reasons that long-term unemployment rate is moving up. Mrs. Johnson there, probably, she was working with a typewriter back in the days in school, and all of a sudden she has to sit here and maybe she worked with a computer, and all of a sudden you're talking about AI. Do you think she can be disconnected to the labor market? Absolutely. So it doesn't just go overnight and say, oh, we'll just run it hot and we'll do all these fancy things. These are the bubble talks that you have into every bubble. And where the salvation is this silver bullet thing that comes in terms of technology, whether it's going to be the steam engine, or it's going to be the electrification, or it's going to be the internet, but it's not going to shade it in a short time frame. 20 years from now, it will completely have redefined our world. But does it prevent a 80% crash on the NASDAQ? It does not.
I really appreciate the insight on this. I last week had Jordi Visser on the program, and we did a deep dive on AI and macro and how that fits in. So if anyone in the audience missed that, I recommend you go check that out. I want to end this conversation. This has been fantastic. I feel like this has been really helpful. I'm sure our audience is going to love this, but I want to end with your thoughts on how you're allocating your portfolio, because as we've said, this bull run, this bubble is likely to continue and go much higher. So how are you thinking about allocating, going into this, as you've said, this expected blow off top in this bubble? And then, you're like you said some things about watching the dollar, watching Singapore, other things for a bottoming indicator. But then after, that the bull runs over, where are you pivoting to protect your capital afterwards? Just walk our audience through your thought process on that, like how you're allocated now and how you're planning to protect after.
See, there's nothing more sad than somebody sitting and actually predicting that there's a top in the market and actually knowing that this guy's short or actually is out of the market, has been standing on the sidelines. That's not what I am. I've been extremely bullish and I've done well since 2022 because I went into the market there and I stayed with the market. And every dip we had also in 22, every dip we have had, I've been buying more. I've been buying every month into the market, various assets. And I'm in the most risk-prone assets right now, you can say, because I think you're going to see an extreme run in crypto here, where we start to see the rotation from Bitcoin into Ethereum, while Bitcoin finds its major top, by the way. So I have not stood on the sidelines, and I don't stand on the sidelines right now. I'm actually in the most risk-prone assets you can find, and if things are going like I hope and suspect it could, then I'll do really well. So I'm not one of those sad people. Actually, I am saying this with my stakes all in on the bull side. So when I see this moment, when I start to see the levels, when I start to see the certain outcomes, look at the Hang Seng, look at the different, and also the Nikkei also reaching some levels now that I think can be interesting to see. Normally, you could actually see the Nikkei could top out sometime before you see the S&P. So I'm starting to look to some of these indicators also, and then just comparing them with the levels that I have, and also when you start to see some of my imminent indicators of a recession, which means the recession comes 1 or 2 months later. Well, then I probably get out. I have the levels that I'm focusing on for all the assets that I hold, and if I get 50, 60, or 80% of that, I'll be very happy. But I will also be ready to get out from one day to the other. Where do I go? I will go to the dollar. and I'll start. Actually, I was thinking for the first time today, actually starting to allocate. I know the dollar will go a little higher, lower. Sorry, here, but I'm starting to think, oh, maybe it's time to start allocating into the dollar because everybody hates it. Will hate it more and more, and I'll love it even more then. So I think we're going to go into the. We will see that there's fantastic liquidity drainage coming when a bubble like this bursts, and it will. And you're going to see people will be needing the dollar to untangle from whatever kind of setup they have. We all kind of short the dollar in the world if you hold debt, so to a certain degree. So when the dollar goes up, it's not a good thing for the world. So we will actually feel the heat of that. And that's why I think if you see 120, 117, 120 on the Dixie, it's not going to be a good day for risk assets. So I'll be out of today. I could be in, and when I start to see my indicators flashing, and it'll need to be one more. That's just a one, or it's not a level, or it's not a date. It's like portfolio of different assets different signals that I'm looking to, and when they are telling me, okay, now it's probably a good time, then I'll get out. But we could be, as I said, 7,800, 8,000 even on the S&P in terms of levels could be reached, and I could see a lot of upside to some of the small caps actually still. I mean, and that's the part of the rotation where you see the large cap starting to lose a little steam, and then you'll see the money rotating into that. And I think that process, we haven't seen that yet. That can be a very, very lucrative phase if you know how to play it. So that's what I'm trying to do. Hope I'm clever enough to do that. But as I said, I can be out overnight. It can be very, very quick if I start to see some flashing and say, okay, this is it. This is enough for me. And certain great investors, much fantastic investors like Warren Buffett said, well, he has had enough. It seems though he's starting to trim his portfolio and is in with more cash now than he's ever been before. I think it's up to the risk profile of anybody, and I would not encourage anybody to just blindly follow me, because I know my risk profile and I know what I can lose and I know when I will get out, and I also know that I've been long since 22 in a very big way. So if I should lose 5 or 10% on the top, I can live with that. So, it'll be about that dollar and bonds on it, obviously, because the yields will decline into a deflationary bust.
Gotcha. Yeah. So I think what I'm hearing is you're saying everyone has to make their own plan based on their specific circumstances, their risk appetite, and then not being tied to specific price targets, but paying attention, taking in the information the market's giving you and reacting. And so this is a great time for people to stay educated, stay connected. Joining the Milk Road Macro Pro community is a good way to do that. And then, I'm glad you mentioned bonds, because I was going to ask that exact question. Warren Buffett has been sitting on $330 billion of cash. And it's been kind of confusing to me as to why he hasn't moved into bonds. And I'm curious about your thoughts on that too. Do you intend to hold mostly cash, or do you think you'll allocate most of that or some of that to bonds? Like, what is your thinking on that? Because I've honestly, hearing somebody say I'm going to allocate to the dollar as a defensive position is like, it's just wild to hear. But it makes sense.
It's the only thing you want to do if you have a deflationary bust. I mean, where do you want to run? And if you say, I want to run to gold, really? You want to run to gold? You know that it dropped by 30, 40% of 60% for silver's matter back into the recession. If you get a deflationary bust, you can see that yields can be coming down. That's why you can move into bonds. Probably I'm just going to go long some ETF and actually some spot positions on the short euro the dollar at the right time. I don't find a lot of things that is attractive into that kind of deflationary development phase. And you can just look to 2008 March to let's say September, October, which asset was interesting to hold there? Gold, silver? Not. Silver dropped by 60%, gold by 35%. And the only thing you could see was the bonds did okay, and the S&P obviously dropped. So you will be a phase there where it's really about who holds the greenback, and then be ready for that next phase. And the next phase will be when the central banks are coming in again, when the Fed comes in. That's the next phase. And I just want to say there are different phases in this, what we can see in this top. And I think that's also why it can be very, very difficult for the average investor to actually navigate in this. And they're going to get squeezed, crushed, whatever they do, if they hold on to things. And holding on to cash into a deflationary bust is not a bad thing. And then there will be a time to take care of inflation down the road when things are starting, because we are in a long-term inflationary regime now. But long-term inflationary regime doesn't go up in a straight line. They go up in a like that. And I think we have one of the busts first in terms of yields. That's why I could hold bonds. But maybe I would think that also Warren Buffett has, but without knowing it, some bonds at this point. Yeah, I would think that is probably some of his what you can call close to cash, because it's it's something he can convert into cash in no time.
Well, Henrik, I really appreciate you coming on the show today. I learned a lot. I'm sure our audience is going to love this, and I'm definitely going to have to ask you back when we get to the next phase to figure out what your thoughts are then. But for now, where can we send people to find more of you and your work online?
Well, they can look to at Henrik Zeberg or on X, or as also at Henrik Zeberg on Substack. I also run a Substack there where you can find articles and also even follow my portfolio if you want to. So that's where you can do that.
Awesome. Well, thank you again so much for being here. I really enjoyed this, and I hope we can have you back again soon.
Likewise. Thank you very much.
Thank you. And thank you all for joining us. I hope you all enjoyed the episode. Stay safe, stay bullish, stay educated, and we will see you all on the next episode of Milk Road Macro. Thanks, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.